Okay, in this video, we're going to see if we can put some of these concepts of buying assets and the net present value. Let's see if we can put some of this to work. So the first project here, we have a security, has a risk-free payment of $1,000 in 1 year. If the risk-free interest rate is 5%, what can we conclude about the price of this bond in a normal market? In other words, what do you expect to have to pay for this asset if the risk-free rate's 5% and in 1 year you get this $1,000? Well, the easiest way to do this is just to calculate the present value of the project, right? So $1,000, 5% in 1 year, right? Compound frequency is 1 year. Then the value of this asset is $952.38. So if you paid $952.38 today and it actually earned 5%, you would have $1,000 at the end of the year. So that is the value, if you will, of this asset. So if you, let's say you could buy this asset for $900. Would you pay $900 for something that was worth $952? And of course you would. Now, if you subtract the $952, subtract $900 from that, that's $52. So that means if it costs you $900, it's worth $952. Then in this case, what this is telling you is you would have an increase in value, increase in benefit, in wealth of the $52. So unless the price of the security equals the present value, right, then arbitrage is possible. So if we have a no arbitrage price of a security, then how do we find, or how would we find the overall values in this calculation? So the process says you have to know what all the cash flows are. Again, this is all forecasted. So we do have to understand that there is some uncertainty with these cash flows. You also have to understand what the cost is of replicating these cash flows. What this is asking you is, what is the required return or the cost of financing to pay for these expected cash flows? So the price of the security equals the present value of all the cash flows paid for the security. So again, we have this risk-free bond, pays $1,000. If it's currently trading for $929.80, the bond's price has to be equal to the present value of the cash flow it's going to pay. So what interest rate would you earn on this particular asset? This is just asking us to solve for the interest rate, for the return for this type of investment. And again, if you look at the time value chapter or the time value worksheet, you can see that if you solve for the interest rate is 7.55%. So that's what you would earn if you paid $929 on the $1,000. Now remember that other example, same kind of example, except they were asking for value. In this case, we'll say, look, you're going to pay $929. Instead of getting the 7% that's the risk-free rate, because of this price, you're actually going to earn 7.5%. So you're going to earn a higher rate of return. So in a normal market, the net present value of buying or selling a security is zero. And this is a very important concept, right? Most people think that when companies issue securities, that creates some type of value for the company. The net present value of buying or selling a security is 0. So what that means is it is a net sum 0 transaction. The net present value of buying a security should be equal to 0, and the net present value of selling a security should be 0. So trading securities in a normal market neither destroys or builds value. So where does the value come from? The value is created by the real investment projects of the firm. It's the assets that we buy that create the value for the firm. The securities that are issued are just the mechanism to achieve or to acquire those funds. So we have another theory to kind of talk about. It's something called the separation principle. And essentially what this says is that there are really, when you're buying an asset, there are really two decisions that take place. Number one, what is the benefit? What is the value of buying this security? The second part of this then is how are we going to pay to get this security? If we know what the costs are, the separation principle says that these two decisions are separate. So as we're thinking about investing in projects, we don't need to think about the financing aspect. It's already part of the calculation, if you will. So we don't have to think about it in general. Now, in reality, this is all done simultaneously, maybe by two different groups of folks, right? There is probably a financing committee in a corporation, and there's an investments committee, right? So there are probably two different groups of people, but they are happening simultaneously, but yet separate. So the law of one price also has some implications about packaging of assets. So here we have a formula down below here, and I like this formula. So let me see if I can make this formula just a wee bigger for us here. Sorry, big. So here we have a security or a portfolio, price C, right? That C is the combined asset. So the combined asset, C, has two parts to it, A and B. So the price of A plus the price of B has to equal the price of C. If that is not true, then we have arbitrage kinds of opportunities, or we have values that are added to the wealth of the company. So the first question we have, and it's just a basic question of building businesses, is how can I increase the value of C? How can I make this number bigger? Well, if you look at our formula, there's only two ways, right? You either have to increase the value of A, increase the value of B. So two ways, or one way to increase the value of a company is to increase the value of the assets within the company. The only other way to increase value then is to add an additional asset. Let's add an additional asset. So if we add asset D, that will increase the price C because it is another added part, if you will. So here's how we might use this in a kind of a practical application, right? We have a company. It's a publicly traded company. It only has three assets. It owns 50% of the Dew Beverage Company. It owns 70% of Mountain Industries. And it owns 100% of the Oxford Bears. It's a football team. Now, here's something about these companies. Dew and Mountain are publicly traded companies. They have their own values. But Oxford is a private company, right? It doesn't have stock. So we would like to know, what is the value of this football team, right? So the total market value of Moon Holdings, the entire holding company, is 200 million. The total market value of Dew is 75 million, and the total market value of Mountain is 100 million. So how do we find the market value of Oxford Bears? Well, so what's 50% of Dew Beverage? 50% of 75 million, 37.5. 70% of Mountain is 70. So if you add those two together, right, that's 107.5 million. Now we know that the entire company is worth 200 million. So if you take the entire company, subtract out the value of Dew, subtract out the value in the company of Mountain, that leaves 92.5 million to cover Oxford Bears. So the value to this company of Oxford Bears is 92.5 million. Again, this is that value added methodology. Now, there are times where you gain synergies and other things when we merge companies together. We're kind of avoiding some of those obvious kinds of benefits that we get, right? So it's in there. So to maximize the value of the entire firm, we managers need to make decisions that maximize net present value. So the net present value of the decision represents its contribution to the overall value of the firm. So where do we go from here, right? We need to understand something about the impact of risk on valuation. When cash flows are risky, we have to discount them at a rate equal to that risk-free interest rate we talked about earlier and some kind of a risk premium. That risk premium is going to be dependent on the riskiness of the asset we're talking about. Next, what is risk aversion? Investors prefer to have a safe income rather than a risky one of the same average amounts, right? So how does our perception on risk impact the value of assets we purchase? And this answer is individual. It's different for every single people. Two people with the exact same set of data can come to different conclusions as to the magnitude and the direction of the changes, the values, everything, right? So risk aversion talks about the person making the decision and their preferences and understanding of risk. So what is this risk premium? For a corporation, we can kind of develop what this number might be. It's the additional return investors expect to earn based on the security's risk. So that has an impact on the marketplace, right? The price in the marketplace. It's going to have a difference in value, obviously, from that of the risk-free rate, right? The market price, how does the market price this risk? These are all things that we're going to explore through later videos. Now, if an asset has more variable returns, right? If it is more uncertain, then it's going to have to pay its investors a higher risk premium. And hopefully this makes a little sense, right? When you invest in something, you want something in return. The more risky that is, the more return you want. So risk is the big factor here, right? The risk of the security has to be evaluated. The security's risk premium is going to be higher. The more its returns tend to vary with the overall market and the market index. If the security's returns vary in the opposite direction, right? If the market is going up and the securities returns are going down, and that's very consistent, then we may have some opportunities for a form of insurance. So there could be actually a negative risk premium. But regardless of this, we need to understand the impact of risk and how that relates to the overall stock market. So that's the end of this video. I look forward to seeing you in the next one.